You've taken a trade, bam, the market turns against you. In just seconds, your gains evaporate. Yet some traders don't want to use a stop loss. But is it really worth the risk? Let's talk about setting stop losses the smart way. The first thing you should do is take a close look at support and resistance levels. Look at the range of the index over the last few days. How much has it moved in 5 days? What about in just one day? When VIX levels are high, it means the market is expected to have big price swings. This could impact your stop loss strategy. Imagine this, you've taken a trade, confident in your position, when suddenly, bam, the market turns against you. In just seconds, your gains evaporate. Scary, right? Yet some traders don't want to use a stop loss. Why? They claim it's because stop losses can backfire, forcing you to sell during quick market dips, just when things might turn around. But is it really worth the risk? Let's talk about setting stop losses the smart way. The first thing you should do is take a close look at support and resistance levels. Think of these as the floors and ceilings of your trading space. Support levels act like a floor where the price tends to stop falling and might bounce back, and resistance levels are like ceilings where the price often stops rising and could start falling again. Understanding these levels is your first line of defense in protecting your trades. Now it's really important to use the right time frame when looking at these levels. The time frame you choose should match your trading style. And here's what that means. If you're a long-term trader, then you look at weekly charts. These charts give you a big picture view of how prices move over a longer period. If you're a swing trader, someone who buys and holds for several days or a few weeks, you'd want to take advantage of short-term price moves, then daily charts are more useful. But what if you're a super active trader like someone trading options throughout the day? In that case, intraday charts are your best friend. Focus on 5-minute or 15-minute charts. These charts give you a better chance to react quickly. But if you plan to hold your position for a few days, then 30-minute or hourly charts are better. They offer a broader view without overwhelming you with too much detail. Let's dive into how to set stop losses more effectively. One of the best things about Punch is how easily you can switch between different time frames on your charts. You can look at the price over various periods and mark the different support and resistance levels. Once you've identified these levels, the next step is to think about how much that stock might move during your trading time frame. This involves analyzing its volatility, which is how much and how quickly the price is likely to change. For those trading options, understanding volatility is especially important because option prices are highly sensitive to these changes. Here's how you can do it. Look at the range of the index over the last few days. How much has it moved in 5 days? What about in just one day? Understanding these movements help you gauge how volatile the stock or index is. Next, check the VIX levels. The VIX, often called the fear gauge, measures market volatility. When VIX levels are high, it means the market is expected to have big price swings. This could impact your stop loss strategy. For instance, when the volatility is high, you might want to set a wider stop loss to avoid getting stopped out by sudden sharp moves. Conversely, in a calm market, a tighter stop loss might be more appropriate. Punch makes this analysis easier by providing built-in widgets. These tools let you customize your view so you can quickly see price ranges and VIX levels without jumping between different screens or apps. Now for option traders, there's an added layer of complexity. You're making decisions based on what's happening with the spot chart, but you're executing your trades on the options chart. This can get a bit tricky. But don't worry, I'll be covering this in detail in my next video. Make sure you don't miss it. A quick recap. We discussed about setting stop losses using support and resistance levels. We highlighted the importance of choosing the right time frame, and we explained how day traders can use weekly and daily ranges plus the VIX levels to anticipate market movement. And don't forget to subscribe and share. We have a lot of great content coming your way every week. See you next time.